Everyone, we're going to go over long versus short dated options. Which one should you be trading? Which one suits your personality, your risk profile better, but also the timing on the long versus short dated options. And obviously, we'll get into price, which ones are going to be more expensive, which ones are going to be cheaper, and how to select the correct option. So let's get to the screens and go over it.
Hey everyone, let's dive into it. Let's first look at Google, which is having a nice day, up 1.5% today. Let's say I wanted to trade it. I wanted to select a long call or buy a call, thinking Google continues its upside, maybe to about 180.5 per share, taking out that prior high. What option should I select? Well, the first thing I always want to ask myself in trading is, what is my max risk? What is my max loss if I'm wrong? For example, let's say I buy Google calls and they announce that they're having problems and the company's down 10% on the next trading day. What's my max loss per trade? Well, if I first look at the July options, and most people will say, always pick an option 30 days out, blah, blah, blah. Well, yeah, that's great. But at the same time, they're A, not going to be sensitive because options are a mark-to-market account. B, they're going to be expensive. Two things. Well, I like the sensitive. I don't like the expensive. So if I go to Google, and I think it hits over that 180, let's say 180.5. I personally like to select the at the money or one strike out of the money calls. So the 175 calls, they're about $4 in the money. I like the 180 calls. If I want to get super risky, I could go to the 185 calls. Obviously, they're going to be cheaper. So the cheaper the option, the further out the money is going to be, the more risky it is going to be. But the higher the ROI will be. When I say the ROI, it means the return on investment or the return on trade really from a mark-to-market account. So you can see the 175 calls in July are up about 30%. Then the 185 calls that I like, or pardon me, the 180 calls about 38%. The ones I like, the 185 calls, which are a stretch, 42%. And then the further, the more they're up, because Google is what we're having a greater than expected market makers move. When a stock has a fast aggressive move in the right direction, the out the money calls are going to move more. How do you know if it's a fast aggressive move in the right direction? You really have to look at historic volatility in a name, how much it moves. You can look at the daily ATR as well. Some stocks like NVIDIA, AMD, Netflix are always going to have big moves implied in them. For example, let's say I go to Netflix, it's up barely anything, $1 today. The July options are down because it's not enough. The options that expired today are down a boatload because, again, even though the stock is up $1, it's not exceeding the market maker's move. And you can even see the next week options are down. So let's go back to that Google example again. If I would think Google has a big move, a fast aggressive move in the right direction, let's say by next week, maybe I think Google hits that 180.5 by next Tuesday. Well, then I can look at the shorter dated options. And now those 180 calls that I like that are $1 out the money, so right on my ballpark, you see how much cheaper they are at $1.78? And they're going to be way more sensitive. They're up 97%. If I want to get super risky, maybe the 182.5 calls, they're up even more, 123%. Now, the in the money options, you can see they're not up that much because they're safer. They're in the money. They're not going to be as sensitive as an out the money option would be. But on the flip side, let's say I'm wrong, right? Let's say Google goes down or stays flat. Let's go back to that example in Netflix. I mean, it's up even. That's the crazy part. But let's even go to maybe Meta, which is down 1%, a very, very small move, right? Meta moves, 1%, and moves like, butter. So in Facebook, you could see the July options, let's say the 500 calls that are almost at the money, they're down 19%. The out the money calls are going to be down more. The in the money calls, they're down less. But here's the issue. They're expensive. They're pricey. My account, I can't trade Meta calls. I mean, I can, but I don't want to be spending $14.90 or almost $1,500 per one contract. So let's say I was trading Meta and I look at the next week expiration. You can see, even though the stock is only down 1%, these out the money options are down 35, 38, 40%. The in the money options, which are going to be more expensive, only down 15, 26, 20% or so. So really, when you're selecting the trade, you really need to see what A is my max loss? What am I willing to risk if all doomsday happens? That's the number one thing you always want to say as a trader. And by doing debit or buying calls or buying puts, buying options, you only can risk the amount that you pay for the option. Personally, if you're trading options over $2, I like using 50% stop loss. Then you should be saying, when do I expect the move to happen? So if you expect the move to happen instantly, quickly, then yeah, you can buy the short dated options. Let's say I buy meta calls and I think, yeah, the stock can hit prior high 530, but it might take a while. Maybe it has an upcoming earnings event in a couple weeks. What is the catalyst? When can I expect the move? You might want to buy a little bit more time. For example, I have a big position here in T, and I have the calls here in T, and I have the July 26 expiration because I know they have earnings on that July 26 date. So my expiration captures the earnings. So I have a catalyst, an upcoming catalyst that can drive the stock. When the stocks usually move 4 times a year, and that's usually earnings. So make sure you consider all these factors when selecting the A, expiration, the B, the strike price, and C, obviously, when you're looking for that move. Obviously, cost will play a role in that, selecting the number of contracts. Obviously, if you want to do more contracts, look at the cheaper options. The cheaper options, the out-the-money options, are going to have a higher degree of risk. Make sure you leave a comment, subscribe, turn on the notification bell, share it with a friend, all that jazz. I'm out.